Welcome to the Deep Dive. We take these, well, really complex topics and try to break them down so you can really get a handle on them.
And today, we're tackling a particularly intricate one, the UK financial regulatory system. I mean, if you've ever glanced at a flowchart, it's just this alphabet soup, isn't it? FCA, PRA, FPC.
Yeah, it looks almost designed to be confusing, but it affects so much from, your mortgage to the stability of the entire UK economy.
Exactly. So we've got some great source material here, and our job today is basically to use it like a map. We want to unpack the whole structure.
Right. Who's setting the rules, who's enforcing them on the ground, and I guess why this multi-layered approach. It's all about stability, protecting consumers, and keeping the institutions themselves sound. That's the goal, isn't it?
That's the fundamental idea. So we'll start right at the top with the big picture policy and risk stuff, and then kind of drill down to the firms you might actually interact with.
Sounds like a plan. Okay, top of the pyramid. Let's talk oversight and policy. That means starting with Treasury.
Yes, the Treasury. They really sit above everything else. They hold the ultimate responsibility for financial services policy, the overall framework, financial stability. But here's the key thing.
What's that?
They are not a regulator themselves. They set the direction, they have oversight, and bodies like the FCA are accountable to the Treasury. But the Treasury isn't, issuing fines or checking compliance day to day.
Okay, so they're the architects, not the builders or the site inspectors.
That's a good way to put it. Now, moving down a level, you get to the Bank of England, the BOE. We mostly think of them setting interest rates, right?
Mm-hmm. A monetary policy committee.
Exactly. But their role in regulation is huge. The BOE is tasked with protecting and enhancing the UK financial system as a whole.
And within the bank, that's where we find this financial policy committee, the FPC.
Precisely.
Yeah.
The FPC, chaired by the Governor of the Bank of England, and its main job is something called macroprudential supervision.
Why we flagged that as big picture. But let's get into the weeds a bit. What does macroprudential actually mean in practice? Are they just like monitoring economic growth?
It's much more specific than that, and definitely forward-looking. They're examining the financial system as one interconnected thing. Their goal is to spot and reduce systemic risks.
Systemic risks.
Yeah.
So not just one company going bust, but the risk of a domino effect.
Exactly that. They're not losing sleep if a small investment firm fails. They are worried if, say, a huge bank's failure could cause a chain reaction, taking down other banks' insurers, maybe freezing up the mortgage market. They're hunting for things like excessive borrowing, weaknesses in the system structure, or credit booms that just look unsustainable.
Okay, but here's where it gets really tricky, according to the sources. The FTC has this built-in balancing act. They have to manage systemic risk, but, and this is the quote, their actions must not harm the capacity of the financial sector to contribute to the growth of the UK economy in the medium or long term.
That is the absolute core tension. You've nailed it. Because let's face it, ensuring stability often means putting the brakes on, restricting activity somehow, which can slow down growth.
So how do they manage that? Do they just issue warnings?
Oh, they have teeth. They have specific powers or tools, as the material calls them, and they're mostly focused on capital requirements, basically, how much cash banks need to hold.
Ah, okay. And the main tool here is the counter-cyclical buffer, the CCyB.
The CCyB, yes. Think of it as the system's main cash safety net. What it does is require banks to build up more capital, hold more cash, during the good times when the economy's booming and credit might be growing too fast, maybe unsustainably.
So they build up this buffer.
And then if a big shock hits the system, like a financial crisis, that buffer is there. It gives banks resilience, stops them from immediately running out of cash and having to slam the brakes on all lending, which would make the crisis worse.
But hang on. If they're forcing banks to hold on to more cash during the good times, aren't they actively pulling money out of the economy? Money that could be used for lending and investment, supporting that growth they're also supposed to protect.
That is precisely the dilemma. It's a massive judgment call for the FPC, setting that buffer level. How much is enough for safety without choking off growth? Every pound held in that buffer is a pound not being lent out. It's a profound trade-off.
Wow. Okay. That's a tough job. Is that their only tool?
No, there's another important one mentioned, sectoral capital requirements, or SCRs.
Sectoral. so more targeted.
Exactly. The sources highlight this lets the FTC increase capital requirements specifically for banks based on their exposure to certain risky areas. The main examples given are residential property mortgages and commercial property.
Okay, so the CCyB is like a general break for the whole system getting too hot, but the SCR lets them cool down specific hotspots, like maybe a housing bubble.
That's a great way to think about it. CCyB is system-wide, SCR is targeted, and these tools, which apply to the big players, banks, building societies, major investment firms, lead us nicely into the day-to-day regulation.
Right, the dual pillars, as the material calls them, the PRA and the FCA. Most big firms are dual regulated by both.
They are, but, and this is crucial, their focus is totally different.
Okay, let's spell out that difference. Starting with the PRA, the Prudential Regulation Authority.
Right. The PRA is actually part of the Bank of England. Its focus is purely on prudential stability. When the PRA looks at a big bank or a major insurance company, they're thinking about the future.
Future risks.
Yeah, they're assessing potential weaknesses. Is the business model sound? Do they have enough capital, enough liquid assets? Is the governance strong? The fundamental question is this institution safe and stable enough to weather the next storm?
And who makes these calls within the PRA?
The decisions are made by the Prudential Regulation Committee, the PRC. And our sources point out something important. The PRC is set up on the same legal footing as the FPC and the MPC, the one that sets interest rates.
Why does that matter?
It gives them significant independence. It helps insulate their decisions about long-term financial stability from, short-term political wins. They are the guardians of whether these big firms are fundamentally sound.
Okay, so PRA, soundness and stability of the big players. Now, contrast that with the FCA, the Financial Conduct Authority.
Right, the FCA. Structurally, it's different. It's not part of the BAA or a government department. It's actually a limited company, but it gets its powers from statute, and its board is appointed by the Treasury.
And its focus is different, too.
Completely. The FCA is primarily about conduct. How do firms in the wholesale and retail markets behave? How do they design, market, and sell financial products and services to customers? They oversee something like 50,000 firms, so their reach is incredibly broad.
Wow, 50,000. So if we wanted a really simple way to remember the split.
Okay, try this. If a huge bank collapses because its investments went bad or it didn't manage its risks properly, that's fundamentally a PRA concern. But if you, as a customer, lose your savings because your bank advisor sold you something totally unsuitable, that's an FCA issue.
Ah, I see. PRA is about the firm's stability, especially the big ones. FCA is about market conduct for everyone, plus the stability of the smaller firms that don't pose a risk to the whole system.
You've got it. PRA, firm safety. FCA, market fairness and consumer protection, and small firm safety.
That really clarifies the structure. But none of this matters if firms can just set up shop without permission, right? Let's talk about getting through the gate, authorization.
Absolutely critical. To do almost any financial business in the UK, a firm needs authorization from the PRA or the FCA, or sometimes both, depending on what they do. And trying to operate without it isn't just breaking a rule.
It's a criminal offense.
Yes, it's a criminal offense. A serious barrier designed to keep unqualified or dodgy operators out.
And that dual regulation idea comes up again here. I like the example in the notes about financial advisors.
Right. If you're a self-employed advisor running your own business, you absolutely need to get authorized. But if you're just an employee working for a firm that's already authorized, you don't need your own individual authorization. The firm's umbrella covers you.
Makes sense. And getting that permission, and importantly, keeping it, depends on meeting certain conditions.
Yes, the 7 threshold conditions. A firm has to satisfy the regulator continuously, not just once, that it meets these standards.
What sort of things are they?
Well, some are structural, like having the right legal status, or for PRA-regulated firms, having your head office in the UK. Others are about capability, having adequate resources to manage risks, enough capital and liquidity.
Okay, the basics of being a stable business.
Right. And also, suitability checking the firm itself and key staff are fit and proper. Looking at the business model, ensuring it's viable and well understood. And finally, making sure the firm can be supervised effectively by the regulator.
What's interesting, though, is what isn't on that list. The sources make a point of saying proven profitability is not a threshold condition.
That's right. And it makes sense when you think about it. Regulation is about safety and soundness, managing risk, not guaranteeing business success. A firm could be run very safely but still not make a profit in a given year. They need adequate resources, yes, but profit itself isn't the regulatory benchmark.
Okay, and the scope of what actually needs regulating is vast. The list includes things like accepting deposits, insurance, managing investments, pensions, SIPPs.
Mortgage lending, administration, consumer credit activities. It covers almost everything you can think of financially.
Yeah, and the actual products, too. Deposits, e-money, shares, government bonds, options, futures, even mortgage contracts themselves.
It's a really comprehensive net designed to catch regulated activities and investments at the point where consumers interact with them.
So we have these two main regulators, PRA and FCA. But they don't operate in isolation, do they? The system relies on them working together.
Absolutely. They both have to follow 8 guiding principles. Things like acting proportionately, considering sustainable growth, ensuring senior managers are responsible, being transparent.
And crucially, they have to cooperate.
Yes, it's mandated. Especially because, as we said, they often regulate the same large firms. There's a formal memorandum of understanding, an MU, between them. They are legally required to consult each other and keep this MOU updated to avoid, stepping on each other's toes or giving firms conflicting instructions.
That coordination must be vital. And it makes sense when you think about the wider regulatory landscape, too. There are other important bodies involved, like the Competition and Markets Authority, the CMA.
Right, the CMA. Their focus is different. Again, promoting competition, looking into mergers, stopping unfair trading practices. You could easily have a situation where, say, the FCA is worried about how clearly banks explain their fees.
While the CMA is looking at those same fees, but asking, is there enough competition in the banking sector to keep fees fair?
Exactly. So the MOU helps ensure the FCA and CMA work together when their remits overlap like that.
Then there's the body, specifically for pensions. The pensions regulator, TPR.
Yes, TPR focuses purely on work-based pension schemes. Their goals are about making sure those schemes are secure, offer value for money, and are run properly.
And they have a specific process if you have a complaint about your work pension.
They do. It's a required 2-step process. First, you must use the scheme's own internal dispute resolution procedure, the IDRP. The trustees have up to 4 months to respond.
And only after that.
Only after you've been through the IDRP can you take your complaint to the pensions ombudsman. That the final arbiter, their decision is legally binding.
Good to know. Okay, quickly, 2 others mentioned are the payment systems regulator.
The PSR, an independent subsidiary of the FCA, actually. Their job is making sure payment systems, how money moves around, are reliable, efficient, innovative, and competitive. Think faster payments, BACS, that sort of thing.
And the Information Commissioner's Office, the ICO. Data protection.
Yes, the ICO enforces the Data Protection Act and Freedom of Information laws. Crucially, the sources stress that breaking these rules, like misusing personal data or ignoring an ICO enforcement notice, isn't just a regulatory slap on the wrist.
It can be a criminal offense.
It can indeed, which shows how seriously data privacy is taken within the overall regulatory framework.
Okay, so that covers the main external bodies. But there are also checks and balances within the firms themselves, right? Required oversight roles.
Definitely. You've got external auditors, the independent accountants who check that the company's published financial statements give a true and fair view, mainly for investors and the public.
And internal auditors.
Their job is different. They work for the firm's own management, reviewing internal controls, risk management, governance, helping the bosses make sure things are running properly inside the company.
And finally, the compliance officer.
Ah, yes, the compliance officer. Every authorized firm has to appoint one. They might be internal or outsourced. Their responsibilities are huge. Writing the rulebook, the compliance manual, keeping records, making sure staff are properly trained, and meet all the FCA's requirements for, say, recruitment or selling practices.
So they're the ones making sure the firm actually follows all these complex rules we've just been mapping out.
In a nutshell, yes. They're the internal police force for regulation.
Okay, so let's try and pull this all together. We've covered a lot of ground, a lot of acronyms. What's the big takeaway for someone listening?
I think the main thing is understanding the structure. Policy set at the top by the Treasury. Then macro-level stability, the really big picture stuff, managed by the Bank of England and its FPC.
Then the dual pillars. The PRA, focusing on the resilience and safety of the big, systemically important firms.
And the FCA focusing on market conduct, how all firms treat customers, plus the safety of smaller firms. And then you have these specialized bodies like TPR for pensions, CMA for competition, ICO for data, PSR for payments, all playing their part.
It really is a highly structured, layered system. It's designed to manage risk at that huge economy-wide level, the macroprudential bit, but also protect you in your individual dealings with financial firms, the conduct part.
Exactly. It tries to cover both the forest and the trees, if you like.
And maybe we can end by circling back to that core tension we talked about right near the start with the
This
FPC,
balancing act, yeah, it's fundamental. They have these powerful tools like the counter-cyclical buffer, the CCyB, to build resilience in the system.
which, as you explained, forces banks to hold back cash during good times, potentially restricting lending.
Right. And remember, the FTC's mandate explicitly says they have to maintain stability without harming long-term economic growth.
So here's the thought to leave people with. Imagine you're on that committee. You know raising the CCIB makes the system safer if there's a crash. But you also know every pound you force banks to hold back is a pound, not funding businesses, not creating jobs, potentially slowing down that vital long-term growth. How do you decide? How much safety is too much if it stifles the economy?
Too small a buffer, the system could collapse. Too big, and you might prevent the growth needed for future prosperity. That razor's edge, that constant trade-off between stability today and dynamism tomorrow, that's the heart of the challenge for UK financial regulation. It must keep the regulators up at night.